In this presentation, we will enter an adjusting entry related to the short-term portion of a loan that has both a short-term and long-term portion to it, a loan that is paid back with installment payments of both interest and principal within QuickBooks Online. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in our Get Great Guitars file. In order to analyze our objective, we'll go over to the reports on the left side. We're going to go to our balance sheet report. We're going to scroll up top. We're going to change those dates once again from 01/01/19 to 02/28/19, our cutoff date for our adjusting entries being the end of February. We want to make things correct as of the end of February so that we can present our financial statements on an accrual basis or as close to it at that time. We're looking at the loan payable account again. Last time, that's going to be liabilities. Last time we broke out this short-term loan, the whole $5,000, in other words, is due within a year, and therefore we can break out the full loan balance. We'll talk more about the interest related to it later, but we can put that into the current portion because any loan balance with it is going to be due within the year. That's what it means to be current versus long-term. Then we're left with the long-term loan, the $69,878. If we select that item, we can see that it's correct because it's the $72,000 loan according to our loan information, and we've made two payments on it, which brings us down to $69,878. We allocated properly the interest and principal, so we're going to check our amortization schedule and say, yep, it was a $72,000 loan. We allocated interest and principal correctly, and therefore we're down to $69,878 after the two payments, which is where we're at now in February apparently. So we're looking good in terms of the balance here. The question now is, the problem is that part of this is going to be current and part of this is going to be long-term. In other words, we're going to pay these every month. We pay it every month, but after 12 months, we're only going to pay this much, and then we're going to be left with the rest that's long-term. So if our goal is to break out the amount that's going to be short-term and long-term, now we've got the same loan that has two different balances. And this, again, is one of those areas where you got to think, well, is it worth it for me to break this out? If I have to present this to somebody else, then clearly I want to break out the short-term and long-term portion if it's required to do so. However, if it's just for my personal use and it's a small business, this is one of those entries where it might not provide the added information necessary to break out the long-term and short-term portion because it changes with each payment. Each payment we make, you're then going to have a different amount as short-term and long-term. Now, why would that be? You might be asking. You say, hey, well, how much do I owe in the future? Well, if I'm here right now and I know in the next 12 months I'm going to make same payments of this amount, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, then I'm always going to be at $16,305 that should be short-term, and the rest should be long-term. But that's not exactly the case because notice that these amounts here, the amount that we're paying, includes both interest and principal. And the interest portion hasn't been incurred. So even though we owe it, that would be like saying that we owe this $13,056 in a few months for rent on a building, let's say, that we haven't used yet. That would be like saying, well, I'm going to put the liability on the books even though I haven't used the building yet. I haven't rented it yet. The same thing's happening here. I can't apply this interest portion to it because I haven't used the loan money yet 2 months from now. And so I can't, this 278 portion of the interest is not a liability as of this date up here, because that would be like saying I plan to rent the building 2 months from now, even though I haven't yet done it, and therefore I'm going to record the liability now as if I incurred it today. No, we didn't incur it today. We're going to incur it 3 months from now. We may plan indefinitely. It's going to definitely happen, but it still hasn't happened. We haven't incurred the rent yet until we consume the use of the building. The same is true with this interest. So the problem then is, of course, we have to take the principal portion, just this amount. This is the amount of the loan balance that we're going to pay back, not the interest. And it changes each time because of the way we set up the loan to make the payments the same. So that means that the short-term portion is going to change every time we make a payment. And that's why we do this periodically at the end of the month. So to properly do this, we would have to say, all right, now I'm going to make 12 payments here. And next year, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So we would be down here once again. These are going to be, I'm going to make these yellow, our current portion. So if you have to break out the short-term and long-term portion, you would do something like this. Here's our principal portion. That's going to leave me with this amount. So this is where we're going to end at the end of the time period. In other words, after we make these payments and then allocate this amount to the interest, the principal reduction will be allocated this amount. This is how much principal is going to go down by, 13,109. 13,109, bringing our balance down. So in other words, this balance is going to be where we are now minus where we will be at the end of this time, which is 13,109. So this 69,878 minus the 56,770 is what we'll pay, 13,109 of principal, this portion, the principal portion. It doesn't include the interest that we'll pay because that's like the rent on the money. That's the rent we're paying to use the money, which we haven't incurred yet. So we can't put that on the books as if we owe it here because we don't owe it until we start to use the money for the next time period. So that's kind of the tricky part. So this is how you look at an amortization table then to break it out. Where you're going to say, well, here's the total balance that we owe as of this point in time after 2 payments. And then this is what we're going to owe a year later. So that means that this amount is what's still owed. I'm sorry, this is what's still owed as of a year later. The difference between those two then is the current portion, the principal portion that we will be paying on the loan. So what we want to do then is take this amount, this is what's going to be recorded here, 69,878, and we're going to have to break out the current portion of it, the current portion being 13,109, which will leave us with the long-term portion, the amount that we're going to pay after a year's time period, the 56,770. Okay, so we'll do that with a journal entry. So if we go back over here, we're going to go back to the journal entry, break out the current portion of it. If I go back to our report then, notice this is going to muddy the waters a lot because now we're going to have a current portion having 2 loans in it, that 5,000 and the current portion of this long and short-term loan that has 2 portions to it. And then the long-term loan is just going to have the long-term portion of the long-term loan. So let's do this. We're going to go to the accounting on the left side. We're going to go to the accounts that we need. It could be either the current or long-term loan. I'm going to go into the long-term loan. So here's the current loan. I want to go into the loan payable under the long-term liability. So it's a note payable. We're going to select that item. And then we'll make an adjustment, an adjusting entry, as we've seen in the past. As of 02/28/19, all adjusting entries are as of the cutoff date. We're going to make the memo that's just going to say ADJ entry. It's going to be an adjusting entry, in other words, and we're going to decrease this amount. We're going to decrease the loan. We're going to decrease the bad thing. We're going to decrease the liability by the 13,109, which will leave us with 56,770. So 13,109. 13,109. The other side is going to be that current loan. So it's going to be loan payable current, the current portion. So it's a other current liability as opposed to a long term. So that'll be it. We'll say save. And then let's go back and see what happens to our financials. To do that, let's go to the reports on the left. Let's go to the balance sheet. We'll run the report again. We should have kept it open last time, but that's okay. 01/01. 19 to 02/28/19. So we're going to run that report as of the cutoff date, 2/28 February. And then if we scroll back down, we're going to check the long-term portion first. That 56,769 now matches. 56,760 is off by $1 because of rounding. So now we're at the long-term portion. That's what's still going to be due after a year's time has passed. The current portion is this 13,109. So if we go back up to the current portion, it's going to be the 13,109. it's different because the 5,000 is in there. If I go into that item, there's the 13,109, there's the 5,000, another loan that's included. That 5,000, which is all current, a different loan, plus the 13,109 gives us that 18,109. This is the principal portion of our loan balances that are going to be due within the next year. So it doesn't matter which loan they are. There's two loans involved here. This is what's going to be due in terms of principal portion, not interest, within the next year. If we go back to our report and go to the long term, here's the long term. This is what's still going to be due after the end of the time period, after the year, still be left. Notice as we see these adjusting entries, we labeled them here adjusting entry, which is nice. And we've got the journal entry. It's always going to be a journal entry, which will give us another indication that it is indeed an adjusting entry. I like to go back into these adjusting entries, see the journal entry, and make sure I have the description on both sides. So whichever account I go into, whichever GL or transaction report, we have it on both sides, and we can save that. And then I'm going to close this back out, and we'll go back to the report. So that's going to be the summary of that. Then again, just remember that this is one of those types of entries that you may not necessarily need to do if you're a small company, and it might confuse you more to break out the short-term and long-term in this format. Even if you have like one loan that has a short-term and long-term portion, it might be better for you for your informational decision-making purposes to break out loan accounts by different loans to be able to track more easily different loans with their own line item, with their own account. For more accounting information and accounting courses, visit our website at accountinginstruction.info.